What if I told you that thousands of Americans think they're saving 15% for retirement, but they're actually falling behind every year? Most people believe that if they're saving 15% of their income, they're automatically on track for retirement. But here's the reality. The biggest retirement mistake isn't how much you save, it's how you measure it. A simple misunderstanding between before-tax savings and after-tax savings could create a massive gap in your future wealth, and most people never realize it until it's too late. Welcome back to American Dream Finance. In this video, you'll discover the hidden mistake many Americans make, how to calculate your real retirement savings rate, and the simple framework financial planners use to stay on track. Because if you get this wrong, you could retire with far less money than expected. But if you get it right, you can build a stronger and more secure retirement plan starting today. And make sure you stay until the end, because I'll show you the one question that can instantly reveal whether your retirement strategy is actually working, plus a simple action you can take today to improve it. The biggest retirement savings mistake Americans make. Most Americans have heard the same advice for years. Save 15% of your income for retirement. Sounds simple, but here's the problem. Very few people know what that 15% actually means. Is it 15% of your gross income before taxes, or is it 15% of your take-home pay after taxes? Those are completely different numbers, and this misunderstanding causes many Americans to believe they're on track for retirement when they may actually be saving less than they think. Let's look at a simple example. Imagine Sarah earns $100,000 per year. After federal taxes, payroll taxes, health insurance, and other deductions, she brings home about $70,000. Now she decides to save 15% of her take-home pay. That sounds great.
But 15% of $70,000 is only $10,500. If financial planners are talking about 15% of gross income, the target would actually be $15,000. That is a difference of $4,500 every single year. Over 30 years with investment growth, that gap can become hundreds of thousands of dollars. That is why this issue matters. The mistake is not that people are saving. The mistake is that many Americans are measuring their savings against the wrong number. And the confusion gets even bigger because different retirement accounts work differently. For example, a traditional 401k uses pre-tax dollars. A Roth 401k uses after-tax dollars. An IRA may be pre-tax or after-tax depending on the account type. So two workers can save the exact same dollar amount and still feel a very different impact on their monthly budget. This is why retirement advice often feels confusing. The headline rule sounds simple, but the details underneath it are what determine whether your retirement plan succeeds or falls short. The real question is not, am I saving 15%? The real question is, 15% of what? And if you don't know that answer, you may be making one of the most common retirement planning mistakes in America today. Now that we understand the problem, let's talk about the solution. The goal is not to argue whether gross income or net income is better. The goal is to make sure you are saving enough for retirement while still maintaining a lifestyle you can realistically sustain. Here's the approach I recommend. Step 1. Use gross income as your retirement benchmark. When evaluating your long-term retirement progress, start with gross income. There is a reason most financial planners use this method. Gross income is consistent. Taxes change, states change, filing status changes, tax laws change, but your gross income provides a stable benchmark that can be used by everyone. For example, if your annual income is $100,000, then 15% savings rate equals $15,000 per year. 20% savings rate equals $20,000 per year. 25% savings rate equals $25,000 per year. This allows you to compare your progress against proven retirement planning guidelines. Think of gross income as your retirement scoreboard. Step 2. Count every retirement dollar correctly.
Many Americans underestimate how much they are already saving. When calculating your retirement savings rate, include
traditional 401k contributions, Roth 401k contributions, IRA contributions, employer matching contributions, HSA contributions used for future healthcare expenses. For example, you contribute $12,000 to your 401k. Your employer adds another $3,000 match. Your total retirement savings for the year is actually $15,000. Many workers only count their own contribution and forget the employer match. That creates an inaccurate picture of their progress. Step 3. Pressure test your plan using take-home pay. This is where many retirement calculators fail. A retirement plan may look great on paper, but if it destroys your monthly cash flow, it probably won't last. Ask yourself, can I comfortably pay my bills? Can I handle an emergency? Am I constantly relying on credit cards? Am I able to stay consistent every month? If the answer is no, your savings rate may be too aggressive for your current stage of life. Remember, a retirement plan only works if you can stick with it. Step 4. Increase savings gradually. Many Americans make another mistake. They hear they should save 15%, then they try jumping from 3% to 15% overnight. That often fails. A better approach is gradual increases. For example, year 1, save 6%. Year 2, save 8%. Year 3, save 10%. Year 4, save 12%. Year 5, save 15%. Most large 401k plans even offer automatic annual increases. Small increases feel manageable. Large jumps often feel painful. Step 5. Focus on the long game. Retirement success is rarely created by one perfect year. It is built through decades of consistency. A worker saving 15% consistently for 30 years will usually be in a much stronger position than someone who saves 25% for a few years and then quits. The most important number is not this month's savings rate. It is the savings rate you can maintain for the next 10, 20, or 30 years. Retirement wealth is built through consistency, not perfection. That is why the smartest Americans use gross income for planning, but they also make sure the plan fits their real-world budget. Both numbers matter. One helps you prepare for the future. The other helps you survive the present, and successful retirement planning requires both. So where do you go from here? If you remember only one thing from this entire discussion, remember this: saving 15% does not always mean the same thing. The number itself is not the most important part. Understanding how that number is calculated is what matters. Many Americans spend years believing they are following retirement advice correctly. Then one day they discover they were measuring their savings against take-home pay instead of gross income. Or they realize they forgot to include employer matching contributions. Or they discover they were saving aggressively but never checked whether their plan was sustainable. That is why today is the perfect time to perform a retirement checkup. Action number 1. Calculate your real savings rate. Take a few minutes and find 3 numbers: your annual gross income, your total retirement contributions, your employer match. Now divide your total retirement savings by your gross income. That gives you your actual retirement savings rate. Many people are surprised by the result. Some discover they are ahead of schedule. Others discover they need to make adjustments. Either outcome is valuable because now you know the truth. Action number 2. Look beyond the percentage. A retirement savings rate is only a tool. It is not the final goal. Ask yourself, am I reducing debt? Am I building long-term wealth? Am I creating financial security? Am I improving my financial position every year? If the answer is yes, you are moving in the right direction. Action number 3. Make one improvement this week. Do not wait for next year. Do not wait for a promotion. Do not wait for the perfect time. Take one small action this week. Examples:
Increase your 401k contribution by 1%. Open an IRA. Turn on automatic investing. Review your employer match. Set up an annual savings increase. Small actions repeated consistently create massive results over time. The most important retirement lesson. The biggest retirement mistake is not saving too little for 1 month. The biggest mistake is never understanding whether your savings plan is actually working. Gross income helps you measure progress. Net income helps you measure affordability. Successful Americans use both. They use gross income to stay on track for retirement. They use net income to make sure the plan fits real life. And when those two numbers work together, retirement planning becomes much clearer. At the end of the day, retirement is not about chasing a percentage. It is about building enough wealth to create freedom, security, and peace of mind later in life. So the next time someone says, just save 15% of your income, pause for a second and ask, 15% of what? Because that one question could completely change your retirement future.